Welcome to the Tim Booker channel, where wisdom deserves to be shared. Today, I'd like to talk to you about a book called Buffettology. What does it cover? It delves into the investment strategies of the renowned Warren Buffett, often referred to as the Oracle of Omaha. Warren Buffett is a household name in the world of stock investing, and for good reason. He's considered one of the greatest investors in history. Just to give you an idea of his prowess, he turned $10,000 into over $200 billion through stock investments. That's a sum most ordinary families couldn't spend in 10 lifetimes. In 2008, Warren Buffett briefly surpassed Bill Gates as the world's richest individual, according to Forbes. Every year, Buffett's annual letter to shareholders is regarded as an investment Bible by the financial community. On February 25, Berkshire Hathaway, the company led by Warren Buffett, released its annual shareholder letter, providing valuable insights and advice to investors. So, what's the secret to Buffett's success? It's a question that many aspire to answer. However, Warren Buffett has always maintained an air of mystery, requiring his family and friends to keep his investment activities strictly confidential. In fact, most of Buffett's work is done from the comfort of his own home. His family is well versed in his investment principles, but they maintain discretion. How did Warren Buffett pass down his investment wisdom to his heirs? Every Christmas, Buffett would give each of his children, including his sons-in-law and daughters-in-law, an envelope containing $10,000. They were expected to exchange this money for equivalent stocks, which were typically the same stocks Warren Buffett had recently invested in. Unsurprisingly, this inside information often led to significant stock price gains. It's clear that Warren Buffett's Christmas gifts were not just generous, they were investments that continued to appreciate. Now, you might be wondering how you can gain access to this kind of information. Well, the author of this book, Mary Buffett, happens to be one of Warren Buffett's heirs. In the 1970s, she was a successful businesswoman, running 2 companies. Later, she married Warren Buffett's son and became part of the world's wealthiest family. Over time, she developed a deep fascination with Warren Buffett's investment magic. She began studying the annual reports of Buffett's company, the letters he wrote to his partners, and even attended his lectures at Stanford University. If her marriage had remained happy, she might have kept her lips sealed. However, after her divorce, she decided to unveil the secrets of Warren Buffett and share his investment philosophy with the world. Mary Buffett enlisted the help of investment analysis expert David Clark, a close friend of the Buffett family and one of the best young minds to grasp Buffett's investment techniques. This book encapsulates the unique rules of enterprise value investing that Warren Buffett has spent a lifetime exploring. From fundamental concepts to mathematical equations, it provides the tools to make informed investment decisions. Now, let's delve into Warren Buffett's investment principles, criteria for choosing investments, and the timing of buying and selling. First and foremost, Warren Buffett adheres to the fundamental principle of enterprise value investing. This means that when making investments, you should not only consider the stock market itself but also the economic issues you would face as an owner of ordinary shares in a public company. Instead of asking which stock to buy, Buffett asks which company's stock to buy and how long he plans to hold it. Next, we consider when to buy. Warren Buffett emphasizes that the what and at what price are entirely separate matters. In the stock and securities market, the price you pay determines your rate of return. Once a price is available, you can calculate the expected rate of return. Then, compare this rate with the expected returns from investments in other companies. This straightforward comparative approach is what allows Warren Buffett to make quick decisions. So, once he's decided on a company, he waits for it to be available at the right price. For Buffett, holding excellent stocks for the long term is more valuable than the short-term arbitrage advocated by Wall Street professionals. He often buys into companies when they seem to have dim prospects because he believes that when great companies are temporarily out of favor, it's an excellent time to invest. Let's listen to a real-life example in this regard. Wells Fargo is one of the best operated and strongest banks in the United States. In 1990, the U.S. real estate market was facing a downturn. To address this, Wells Fargo set aside a reserve for bad debts of approximately $1.3 billion. To clarify, a reserve for bad debts refers to the company's estimation of the amount of money that might not be collected. This data is recorded on the company's balance sheet. When a bank sets aside a reserve for bad debts, it is preparing for potential losses in the future, but it doesn't mean that these losses have already occurred or will definitely occur. However, when the losses did occur, they were not as severe as expected. Wells Fargo lost a significant portion of its profits in 1991, but its foundation remained strong. The $210 million in net profit for that year equated to 4 cents per share of common stock earnings. Nevertheless, Wall Street, which often focuses on short-term investment returns, reacted disproportionately. In just 4 months, Wells Fargo's stock price plummeted from $86 per share to $41.30 per share in the U.S. stock market. This 52% drop in valuation was due to the bank's failure to generate significant profits during the market's low point in 1991. Warren Buffett saw an opportunity in this and purchased 5 million shares of Wells Fargo at $57.80 per share, gaining a 10% ownership stake in the company. Buffett's actions were unconventional but calculated. Through his observation, Wells Fargo was one of the best managed and most profitable money center banks in the United States. These money center banks possess a form of monopoly power in financial transactions, much like charging tolls on a bridge. In real life, whether it's a small private company or a large corporation, they all have bank accounts, business loans, auto loans, or home loans. Banks provide a variety of services and earn interest and fees. In densely populated areas like California, where Wells Fargo is located, numerous small businesses and countless financial institutions are clients of the bank. As Buffett foresaw, by 1997, Wells Fargo's stock price had risen to $270 per share. Warren Buffett's investment in 1990 eventually yielded a pre-tax annual return of 24.6%. During that period, many small banks did not survive, making this an excellent example of how well-managed companies, especially those with a monopoly in consumer services, tend to thrive even in economic downturns. They often emerge stronger, while weaker companies struggle or fail. This demonstrates that market downturns can be the best buying opportunities for excellent businesses. So, this is the fundamental principle of enterprise value investing and Warren Buffett's strategy. To summarize, when it comes to enterprise value investing, you only need to understand 2 things: what to buy and at what price. Instead of fixating on stock prices, focus on the business's prospects. Once you've selected a company, calculate the rate of return and wait to buy at the right price. Now, let's talk about the concept of compounding, or compound interest, which Warren Buffett leverages as one of his most potent tools for wealth creation. Compound interest is the process of reinvesting earnings and adding them to the principal, allowing your investments to grow exponentially over time. For example, with an initial investment of $100,000 and a 10% annual compound interest rate, after 10 years, you would have approximately $260,000. If the annual rate were 20%, after 10 years, you'd have around $620,000, and after 20 years, it would grow to about $3.8 million. Even a small difference in the percentage rate can lead to significant differences in returns over time. In Warren Buffett's case, he focuses on achieving as high a compound interest rate as possible over the longest possible time. This emphasis cannot be overstated. Now, let's discuss how to identify outstanding businesses. Warren Buffett categorizes potential investments into 2 groups: typical commodity-type businesses that often underperform and exceptional businesses with characteristics of consumer monopolies. The first group comprises companies where product prices are the primary determinant of consumer purchases. Examples include textile manufacturers, food ingredient producers, steel producers, oil and gas companies, lumber businesses, and paper manufacturers. These companies face intense competition, and consumers primarily focus on price. Therefore, low-cost producers have a competitive advantage, allowing for more significant profit margins. These commodity-type businesses are characterized by low profit margins, low returns on equity, minimal customer brand loyalty, a multitude of similar competitors, and volatile profits that heavily depend on efficient utilization of physical assets. In short, these businesses are not worth investing in because the returns for investors are typically average at best. On the other hand, exceptional businesses possess consumer monopoly characteristics, as we discussed earlier. These businesses have strong brands and recognition, provide products that are highly sought after, and are often exclusive or far superior to their competition. As consumers, we may have no choice but to use their products, much like paying a toll to cross a bridge. So, in addition to having a monopoly, suitable investment candidates should be in an upward trend, have little to no debt, maintain high returns on equity, retain earnings, and have the ability to invest in high-return projects. Alright, after discussing the characteristics that make a company worth investing in, let's take a look at where to find these excellent businesses, as suggested by Warren Buffett. The best approach, according to Buffett, is to stand at the entrance of a supermarket or convenience store and try to identify the brands that these stores must supply. This method is much more effective than flipping through financial magazines and papers, or simply taking out pen and paper and thinking about the brands of products you use every day. Companies behind such brands often have the same kind of consumer monopoly as we discussed earlier. They have brand appeal, and their products are items that businesses are certain to sell. Advertising companies are another avenue to explore. Advertising has become a fiercely competitive battlefield for enterprises. Large companies invest in advertising on a per capita basis, and this is a one-way street. They must continue advertising. This ensures that advertising companies generate significant revenues. Another category you might not think of is companies that do not require products and highly skilled workers. These are service providers, such as security companies and courier companies. These businesses offer services that consumers continuously need, and they don't require significant capital support or highly educated employees. As long as there are thieves stealing, and eBay continues to thrive, these companies will make money. In summary, we've discussed three types of companies: those with products that always sell, advertising companies, and companies providing services that everyone needs. Consider investing in these three types of companies. We've covered various methods for buying stocks. So, when should you sell? The investment market is filled with various theories about bear markets and bull markets, but Buffett's rule is to pay no attention to them. He can do this because he buys or sells stocks based on returns, regardless of market conditions. He hardly considers these market conditions. His primary focus is on the companies he has always followed. Buffett knows that while unpredictable bull markets can offer excellent opportunities, bear markets can also provide opportunities when many company stocks are undervalued. In the 1987 stock market crash, the whole market went crazy, and people were rushing to sell their stocks, trying to avoid risks in the avalanche. At this time, Buffett stood at the bottom of the abyss, silently waiting for the excellent companies he loved. Sure enough, when Coca-Cola's valuation took a heavy blow, Buffett saw this as a rare opportunity. Instead of selling stocks to cash in during these times, he didn't stand idle. He saw what others considered fear as an opportunity. This confidence stems from his investment decisions based on the company's prospects. This approach is fundamentally different from the mainstream thinking advocated by large investment firms on Wall Street. Enterprise value investing focuses more on patterns. Embrace his wisdom, and others' foolishness will be the field from which you reap your benefits. In other words, only when enterprise value investing has commercial value will the mistakes of others, driven by fear and greed, bring you gains. Seize the opportunity to follow these patterns, and you'll be able to profit from your investments. With that, we've come to the end of today's content. Let's recap. This book is all about teaching you Warren Buffett's unique approach to investing in a company's prospects. Don't just focus on the stock's price, instead, consider the company's business outlook. Once you've selected a company, calculate the return, wait for the right price, and make a purchase. Compounding can turn your investments into substantial gains. Once you've purchased a stock, hold it for the long term. But where should you look for these excellent companies? Focus on businesses with a competitive edge, and zero in on three categories: companies with products that always sell, advertising companies, and those offering services that everyone needs. So, when should you buy? Buffett insists on buying quality companies when their stock prices represent a sound business value. Buffett often buys when a company's prospects seem dim because he believes that tough times for excellent companies can be excellent investment opportunities. Whether it's a bear market or a bull market, Buffett disregards various selling theories and sees what others view as fear as an opportunity. He sticks to investment decisions based on a company's prospects. I also want to share some of my personal insights. Buffett spent his entire life learning and adjusting and perfecting his investment approach. As an ordinary investor, you should continually learn from the success experiences of predecessors, understand the investment principles, and absorb the intricacies of this investment method, making it easier to improve your skills in real-world situations, make future predictions, and judgments. Of course, to succeed in the investment field, apart from learning methods and analytical tools, you also need a business mindset. It's not just about the conclusions from your analysis, it's the kind of inspiration that comes from having a business acumen. While not everyone can become Warren Buffett, at least you can keep getting closer to becoming a successful investor. Alright, that's the end of today's book. Finally, I recommend an interesting movie, The Wolf of Wall Street. Perhaps, after watching this film, you will have more thoughts about what we discussed today. Congratulations on finishing another book. Thank you for your support and attention. Please subscribe to the Tim Booker Channel audiobook channel, like, and share with your family and friends. Wisdom is worth spreading, opening the way to a brighter future. Thank you, and goodbye.